I'm sure you've heard this a lot of times. SIP is the best way to invest in mutual funds. But when somebody talks about this, they are usually referring to SIPs in equity mutual funds. You would rarely hear people talking about starting an SIP in debt funds. There's a simple explanation for this. SIP works in volatile assets. For investors to benefit from SIP, the asset price must go through a lot of rise and fall. Take a look at the movement of Nifty 50 index funds NAV. There is quite a bit of volatility you can see in the last 5 years. When such corrections and rallies happen, investors opting for SIPs make money by averaging the cost of purchase. In most debt schemes, however, we don't see the same kind of volatility. I mean, you won't see debt funds giving 50 or 100% returns in 1 year or falling by 20 or 30% in a short span of time. So, if you come to think of it, as debt funds are less volatile, an SIP in debt fund is likely to give you lower returns than a lump sum investment. Of course, there are always exceptions. Take G-Secs funds as an example. They can be volatile like equities. For instance, SBI Magnum Gilt Fund, which is the biggest fund in the gilt fund category, has risen around 6.2% in 1 week and has fallen around 7.2% in a month as well. Nevertheless, the volatility in debt funds is a discussion for another day. For now, let's stick to what happens in the majority of debt funds. If your SIP returns are likely to be lower than lump sum in debt funds, does it make sense to invest small amounts in them every month? You can invest in debt funds via SIP, especially if you are in the 30% tax bracket. But there are few things you must keep in mind. In this video, we will broadly discuss 3 things. 1. When you should invest in debt funds through SIP. 2. Which debt funds are suitable for systematic investments. And 3. Why SIP in debt funds could be a better option than putting away money in a fixed deposit. Let's begin. Many investors put money in recurring deposits every month. They don't do this for higher returns. You would hardly make 5-6% in a recurring deposit at present. Investing in recurring deposit helps to save small amounts every month to create a bigger corpus. Some use it for a short-term goal like insurance payments or school fees. This way, they can maintain financial discipline. Just like investors put money in RDs, you can invest in debt funds every month. It helps you to be disciplined as your savings happen every month automatically. Now you may be thinking, why invest through SIPs when the returns could be lower than lump sum? Generally, an SIP does not guarantee better returns than lump sums. You use an SIP as you don't have a big amount to invest right away. An SIP helps to save for the goals little by little. It enables you to start on your wealth building journey early in life with whatever surplus you may have. SIP in a debt fund serves the same purpose. You save systematically to reach a goal using the surplus money. For those who are still thinking of returns, they need to realize that returns are secondary. SIP is primarily a saving strategy. It's not a tool to generate higher returns. But it's equities that primarily help to create wealth. So what could be someone's purpose or goal to invest in a debt fund using an SIP? Well, you can use debt funds for your short and medium term goals. You can use it to plan an expensive vacation, buy a vehicle, or make a down payment for your house. Basically, any goal that's 1 to 4 years away. Debt funds are also an essential part of your portfolio. Let's say you decide to divide your portfolio in such a way that 70% is allocated to equities and 30% to debt. For the debt allocation, you can use an SIP to maintain your desired allocation. As we discussed in the beginning of the video, not all debt funds are suitable for SIPs. Let's look at which debt funds are suitable for an SIP. In our opinion, a better approach would be to first discuss debt funds that investors can avoid. Now, We can broadly divide debt funds as short term, medium term, and long term. You can give short term debt funds a miss. Basically, avoid schemes that invest in papers of less than a year. These include categories like overnight funds, liquid funds, ultra short term funds, money market funds, and so on. In debt funds, you must choose a fund whose average portfolio maturity is close to your investment horizon. Let's understand it with an example. If you want to invest for 2 years, choose a debt fund that has an average portfolio maturity of around 2 years. Short-term funds are more suitable for lump sum investments. They are meant for investors who need money in a few days, weeks, or months. I would like to point out one exception. You often hear that you should keep a part of your emergency fund in liquid funds. So, if you are in the process of creating an emergency fund, starting an SIP in a liquid fund is not a bad idea. Once you reach your targeted amount, the money can continue to be in that fund. You can also avoid long-term debt funds like G-Sec schemes and long duration funds altogether. These funds typically have a portfolio maturity of 7+ years. Such funds are highly sensitive to interest rate movement. So when interest rates are going up, these funds can give negative returns for prolonged periods. The reverse is also true. When interest rates fall, these funds could offer double-digit returns. As they follow interest rate trends, there is always a possibility that their returns are negative when you are close to your goal. The aim of an investor in debt should always be capital preservation. Now, let's talk about which debt funds are suitable for systematic investments. The sweet spot for investors are funds that have an average maturity between 1 and 5 years. So, you can look at short duration, medium duration, and gilt funds with 5-year constant maturity. You can also look at banking and PSU funds that have the average portfolio maturity that matches with your goal. You can get high quality papers in categories like gilt with 5-year constant maturity and banking and PSU funds. I would like to add one word of caution here. Funds that invest in 1 to 5-year papers can also be a bit sensitive to interest rate movement. There can be short periods of negative returns, but you should be able to tide over this if you stay the course. Now, let's address the next question. Why should you choose debt funds over FDs or recurring deposits? The answer to this question has two parts. The first part is returns. So we looked at SIP returns of the top 3 funds by AUM in each category. You can see the returns of the largest funds on the screen. In the past 3 and 5 years, many funds have delivered returns that are close to the fixed deposit rates. Now comes the second part. There is one important factor you must consider here. I'm talking about post-tax returns. For the past 3 years, bank FDs rates were close to 5.5%. The post-tax returns would be below 4% if you were in the 30% bracket. For those in the 20% bracket, the returns would be below 4.5%. However, if you stay invested in debt funds for 3 years or more, you pay 20% tax but with indexation benefits. Generally, the tax rate comes to below 10%. So you could have made better post-tax returns if you were in the highest tax slabs. Do note one important point here. For investments to be considered long-term, each SIP installment should complete the 3-year period. For those in the lower tax brackets, fixed deposits make more sense as they don't get to benefit much from taxation. Let's recap what we discussed. Investors in higher tax brackets can look at SIP in debt funds for their short and medium term goals, but they must stick to debt funds that invest in papers of 1 to 5-year duration. Finally, when investing systematically, returns should not be your priority. It's a strategy that allows you to invest small amounts every month to reach your goals successfully. If you like this video, then do tap on the like button and don't forget to subscribe to our channel. And don't forget to share this video with your friends and family. Till the next time, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.